Welcome to the Thinksters. Today, we'll cover 5 complex investment banking interview questions, the kind you might get at Merrill Lynch. How would you approach valuing a company with significant non-core assets? When a company owns both core and non-core assets, say, a manufacturer that also owns real estate and a fintech arm, the right approach is a sum-of-the-parts valuation. Value the core operations using EV/EBITDA or DCF. Value the non-core parts separately, real estate with cap rates, fintech with revenue multiples. Then subtract net debt, add excess cash, and adjust for any minority interests. That's how you isolate true operational value. How does switching from leasing to owning assets impact valuation? Switching from leasing to ownership increases balance sheet leverage and depreciation, but lowers EBITDA. Enterprise value itself might stay the same, yet the EV/EBITDA multiple looks inflated. You need to normalize for lease capitalization under IFRS 16 or ASC 842 so that comparisons are fair. Ownership can boost long-term margins, but reduces flexibility and lowers return on assets. If you want to master valuation, accounting, and deal analysis, join our free foundation course. The link is below. What happens to M&A activity if the Fed cuts rates by 150 basis points? When interest rates drop by 150 basis points, cost of capital falls, valuation multiples expand, leverage capacity grows, and deal activity accelerates. Private equity firms return aggressively, and strategics use higher stock prices for acquisitions. However, if rate cuts signal an upcoming slowdown, short-term M&A volume can still cool off despite cheaper debt. A company shows strong net income but negative operating cash flow. Why? When a company posts strong profit but burns cash, something's off. It could be aggressive revenue recognition, working capital buildup, or capitalized expenses hidden under investing. Always reconcile net income with cash flow, track changes in working capital, and check the quality of earnings. In emerging markets, start with relative valuation adjusted for country risk. Use a DCF in hard currency, usually USD, with built-in FX and inflation scenarios. Add sensitivity tables for discount rates and exchange rates. And if data is limited, triangulate with precedent transactions, industry benchmarks, or local broker research. To get a personalized career plan for breaking into investment banking, message Anton Katskalevich, founder of the Thinksters, on WhatsApp at +7 900 16 407 3623. Good luck with your prep, and see you in the next video.